All right, so I have a client, he just asked me, what is the benefit, the change in mortgage interest tax deductions now that the SALT limits have been increased to 40,000? And I think when I was running his example, I was pretty shocked, and it's actually something that mostly benefits homeowners. So I'm sure there's a lot of people out there that will say that's not fair, that you're actually giving a hookup for people that already are doing pretty well in life. And while some of that's true, I think pretty much everything that's happened since the pandemic and before, we realized that policy is probably designed specifically around fostering homeownership and benefiting those people that own a house. But I do think it's important for everyone to understand exactly what this benefit is. So with the SALT limit going up to $40,000, it essentially took people, like this client makes $225,000 a year. He pays $17,500 in DC state income tax, and the property tax bill on the house he's buying is $8,000. So in the old system, he can only write off $10,000 of that instead of the $25,000 total. So now he can write off the full $25,000. Now, because it's under the $40,000 limit. So think about that for a second. His top tier marginal tax rate is 32.5%, and he now gets to write off an additional $15,000, which is a $5,000 refund, bigger refund this year than last year, just from that one change. So I think it's pretty important for anyone out there thinking of buying a house. You should run your calculations, see exactly what the tax implications are. And I will say it does benefit higher income wage earners probably a little more, living obviously in high tax states, but specifically people that have other write-offs so that they can exceed the standard deduction. And by owning a home, you easily do that. If you don't own a house, probably pretty hard. So if you have any questions, you want to run your numbers, please reach out.